Hey everyone, today I'm going to be showing you a chart that predicts recessions without a fail. This is the motor vehicle retail sales heavyweight truck chart that basically shows supply chain related trucks on month-to-month basis and how many of them are being bought each and every month. And when we have a dip, what does a dip represent? Actually, before we do that though, I want to jump into gold really quickly because it deserves a mention. It's almost at $5,000 an ounce. It has an absolutely a parabolic run. It found a bottom in 2022. It's up 200% since in 3 years. And usually, investors, governments, hedge funds, and so on and so forth, they usually flock to metals and specifically gold when they smell a recession, when something's wrong with the economy, when the stock market is just not it. We can take a look at silver. It has also had a very it has had an amazing run since 2022. It's up 500%. It broke the $100 an ounce mark just this past Friday. Gold and silver, they both indicate that something's actually wrong with the economy because they usually rally just before recessions. But I want to point your direction to something else. I want to point your direction to debt balance credit cards in the United States, which has increased to $1.233 trillion in Q3 of 2025. US consumers got $1.233 trillion in credit card debt. And another chart that is rather concerning is the car delinquencies. This is the car loan delinquencies chart. It's at 6.74% in December 2025. That represents roughly just under 7 people out of 100 getting their car repoed in just December of 2025. I want to go back to the chart that I showed you in the beginning. So we have a couple of peaks. You see a peak in Q4 of 1999. You see a peak in Q4 of '06, a peak in Q3 of 2019, a peak of Q4 of 2023. All these peaks, what do they represent when it comes to the stock market? Well, let's start with the beginning. Let's start with Q4 because we of 1999 because we know what happened in early 2000s. That's the dot-com bubble, the dot-com crash. So if we go back to 1999, Q3 of 1999, that arrow here represents Q3 of 1999. Well, you can see that the stock market was actually doing good and it rallied before inevitably crashing down just about 10% more. Then it declined with about 30 with about 50%. Yikes, not good. So the next one is Q4 of '06. Let's see where Q4 of '06 is. Oh, there it is. Q4 of '06. The stock market, by the time it started declining, it rose 13%. It then dipped about 55% in the financial crisis of '08. The next peak we have is in Q3 of 2019. We remember really, really good what happened in 2020. Here is that arrow represents when heavyweight trucks retail sales peaked. The stock market rose about 20% before it inevitably dropped about another 35%. Yep, exactly 35% in a very short period of time. And we had a really great bounce that we're basically still riding technically. We also have Q2 of 2023. That's Q2 of 2023. The stock market did really well for about 13 more percent going up before it inevitably went down 10% because of the great inflation that we had, the double digits inflation and the 5.5% interest rates. So that chart has already peaked in 2023, but it hasn't really plummeted since, but it started plummeting in end of half one of last year. In June of 2025, it started going down rapidly. Although we've had a sort of a bounce off of that level right here, which is kind of expected, we haven't seen anything concrete just yet. So we need maybe a couple of more months before we either see a rebound or we see it doing something like that, just like it's done before. Another thing I want to point your direction to is you might have seen these circles that I've got here that say midterm. So what I mean by midterm is midterm year is the second year after the new U.S. president has taken over the presidency. So I'm going to show you the midterm years since the dot-com bubble. So the first year since the dot-com bubble was it was 2002. The stock market declined by a lot. The stock market went down about 35% since the beginning of the midterm year of 2002. We then had another midterm year that realistically doesn't look too bad. It did have a dip of about 10%, I believe, about 8%. But we do have to take into consideration the huge decline that the stock market experienced a few years prior that midterm year, and we can take that into consideration as to why that midterm year wasn't way too volatile. Now let's take a look at the very next midterm year. Now we know what happened in 2008. The stock market declined by a lot, 55%. Here is the very next midterm year, which is 2010. In 2010, the stock market declined about 15% before it inevitably went up, because the stock market, long enough time frame, it goes up always. Now, the very next midterm year was 2014, and although it looks like it's gone up only, it did have a great scare, declining with 10% in just a month. Now, the very next midterm year that we had was 2018, where the stock market declined with about 18%. Now, the very next midterm year that we have was 2022. The stock market declined approximately 27%. Now, why do I point out to the midterm years? Well, it's not just the midterm years. We need to see the bigger picture here. The bigger picture is this. You have gold going absolutely parabolic because nobody trusts the stock market and the US dollar. We have silver doing the same. We have sales, heavy truck sales absolutely plummeting because the supply chain is not doing very well because of tariffs. We have card debt going absolutely parabolic, not stopping. That's probably the only chart that hasn't dipped in such a long time. And we also have card delinquencies that are the highest in 35 years. When's the next midterm year? Well, you didn't have to ask, because the next midterm year is actually this year. Next midterm year is 2026. So do we see a decline in the stock market going down about 20% back to 2025 Liberation Day, March and April dip? Maybe it takes out the bottom. Maybe it goes even further down. We'll see. I doubt it. It's probably going to be a volatile year because of all we've talked about throughout this video. But I believe if it's going to be a dip, it's going to be no more than 20%, just a recession scare at that point. Just because interest rates are at 3.5%, they're still averagely high. They can get down a lot. The Fed has barely started printing money at that point, and they can print a lot just to get us out of a recession. So the point of that video, guys, is we all as investors need to hope for the best and be prepared for the worst. So what I personally am doing with my own money is I bought a lot of stocks here. I've been writing them, and I've been slowly loading off at that point. I've basically kept my winners, gold, silver, and uranium. I've kept some old stocks because I was having a very fun time right now, and I've kept my S&P. I've sold off all of my crypto because no need for it. It's a very risk off time. That's why the gold is going up, and Bitcoin is not gonna have its time of day anytime soon. But I'll make a dedicated video on Bitcoin, exploring what it can do, what it can be by the end of 2026 soon. So stay tuned for that. But the whole video, if you need to take one thing out of that video, is you need to hope for the best, but you also need to be prepared for the worst. Because if we get a 20% decline, I'm sure you would love to have some cash on hand to buy the dip. So have cash on hand to buy a potential dip just because of gold, of silver, of midterm year, of debt, of car delinquencies going up, of truck sales going down, so on and so forth. There's many indicators that show that the economy is struggling. It has slowed down to a crawl. So has the labor market. So we can expect some volatile times throughout 2026. Stay prepared, stay hungry. Thanks so much for watching that video. Comment, like, share, subscribe. Tell me down below why you think we might have a recession. Tell me why you think we're not gonna have a recession. I'm open to have a very productive discussion. Thank you once again for watching, and see you in the next one. Bye.